crushing volumes were lower on a quarterly and half-yearly basis, reflecting our strategic focus on margin expansion and consciously reducing sales of low-margin end products. Regarding H1 FY26 segmental performance, the industrial and steel segments delivered revenue growth. Consumer segment was largely stable, while the infrastructure segment faced a dip due to focus on value-added products and impact of delayed monsoon. The industrial segment delivered a healthy 19% YOY growth, supported by a 7% rise in exports and a strong order pipeline. Micronized rubber powder and reclaimed rubber volumes expanded by 20% and 4% respectively, while rubber conveyor and molded good business continued their steady performance. The steel segment delivered encouraging growth, with revenue rising 6% on year-on-year basis and sales volume by 21% YOY basis. While revenue growth has slightly moderated by lower steel prices due to cheap scrap imports, the strong volume growth underscores operational strength. In the infrastructure segment, revenue was strategically focused on value-added products, reflecting a cautious approach to curtail sales of low-margin commoditized products. While overall revenue was lower on YOY basis, CRM business have grown impressively by 75% volume growth, highlighting a strong demand for our higher value offerings. The consumer segment maintained largely stable revenue despite a marginal drop in volumes, reflecting the impact of price correction. Demand is expected to grow in the coming quarters, supported by seasonal shift from the extended monsoon and short-term market liquidity adjustment. Coming to Concall financial performance, in H1 FY26, revenue saw a modest 3% dip. However, basis our order book and forecast for H2, we expect to close the financial year with a 10 to 15% growth over last year. In TRIL, the EBITDA and PAT margin remained strong at over 17% and 9% respectively. TP Buildtech, our associate company, reported a PAT of Rs 98 lakhs in H1 FY26. With the 50% YOY decline, the decline in margin has happened due to higher cost incurred in launching new product as well as in ongoing stabilization of the new unit on Kolkata to cater the eastern region. In TRIL, amongst contribution from subsidiary and associates, PAT was impacted by startup cost incurred in Bodla Investment South Africa and Tinna Rubber Arabia. We expect Bodla to become break-even by end of Q4 of this financial year. In Q2 FY26, revenue grew on year-on-year basis but saw a slight QOQ dip. EBITDA improved on both YOY and QOQ basis, while PAT remained steady at around rupees 12 crores. Tinna Rubber is making a strong progress towards its Vision 2028, driven by strategic capacity expansion, capital investment, global sourcing, and business integration. With a diverse product portfolio, international focus, and experienced leadership supported by committed stakeholders, the company is well positioned for sustained long-term growth. I would now like to open the floor for question and answer. Thank you, and over to you, moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Roy from DAM Capital. Please proceed. Mr. Aditya, your line has been unmuted. Please proceed with your question.
Good afternoon. Sir, you mentioned in Q1 your top line will be rupees 600 crores. With that run rate in H1 FY26, Are you confident of achieving the same in FY26, especially if you continue to have focus on value-added products?
Hi Aditya, this is Gaurav Sekhri. I believe after the results of Q2 that we have now, I think the more likely growth that we will achieve this year is between 12 to 15% over last year. I think 600 is at this point of time seems not possible to achieve. I think we will be more like a 12 to 15% growth over previous year in the current financial year.
Thank you, sir. I had another question. As you had mentioned in your presentation that price corrections have started to come in the consumer segment, do we expect this in other segments as well? And also, could you please tell me the capacity that we will be setting up for recovered carbon black?
So on the first question, I didn't understand what part of our speech you picked up and what question you are asking. Can you repeat to me once again what is it that you wish to know?
Of course. So you had mentioned in your presentation that price corrections have started to come in the consumer segment. Do we expect this in other segments as well, similar to the consumer segment?
No, I'm Subodh here, Aditya. So price correction is in the consumer segment is, slightly better, but on the other side also we are, requesting our customers, but in the consumer segment, because of the extended monsoon and all, and it was a requirement, some correction, so we requested and it had happened. But in the other segment, we are already almost, at par. Maybe we will request our customers to improve it further.
Okay, sir. Thank you very much. Lastly, I had asked if you can please tell about the capacity that we will be setting up for the recovered carbon black.
See, the recovered carbon black and, we are setting up a plant with the 100 tons per day capacity of feed, which will generate around 40% of oil and around 40% of the recovered carbon black.
Understood. Thank you very much, sir. Thank you. Best of luck.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 now. The next question is from the line of Saurabh from SB Capital. Please proceed.
Yeah, hi. Am I audible, sir?
Yes, please go ahead.
Yeah, just wanted to check what component of other expenses have increased in this quarter. And could you please also explain why the employee cost has gone up?
See, Gaurav here. So the employee cost has gone up primarily because some of the new projects that we have undertaken, whether that is PCMB or the RCB plant which is being set up, we are already in the process of recruiting talent, manufacturing, marketing, etc. So that has resulted in some increase in employment costs, but this is just to get ready for these new plants which are becoming on stream and for new product development. I hope that answers your question.
Okay. And as we have already said that the reasons you have given for the dip in the performance for this quarter, can you please tell us how do you plan to mitigate the losses in the upcoming quarters?
See, firstly, our EBITDA margins have improved. We have operated at 18.5% EBITDA this quarter, which is I think we are very satisfied with that performance, and we are hoping that we can maintain this over the next remaining part of the year. So that's point number one. So I would not call that as a dip in performance. In regards to our overall sales being lower than what we had expected, that is a combination of two things. One is the extended monsoon Always Q2 for us is a weaker quarter in terms of top line because of monsoon, but this year the monsoons have been extended and delayed, which has impacted our sales to some extent. And second is for some conscious pullback on the commoditized side of our business to improve our margin profile. And that is sort of in our hands. We can always do more of it whenever we see that making sense. So that is where we are at. I mean, yes, we were expecting to grow at about 20% this year. I think that will not happen. We will finish the year at between 12 to 15% growth is our estimate.
Okay. And can you please also throw some light on startup costs that we are expecting from the South Africa and Saudi Arabia in the next half year and the upcoming year?
In regards to Saudi Arabia, that is, we have not yet commenced operations. We are still only the costs we are incurring is to pay the statutory dues or in getting some surveys done in relation to build up of the plant. So it's basically those kind of startup costs, and that to a large extent have been done, and of course some more will be done over the next few months, but not in any that will not have any major impact. In regards to Bodla, the operation started a few months ago. At this point of time, Bodla, our joint venture is losing money, but we expect that to change from maybe January onwards, and we expect to get to more or less break-even kind of run rate by the end of Q4 in South Africa.
Okay, and I have a last question as well. In the TP Buildtech, so how are you expecting the performance in the upcoming quarter and the next half?
TP Buildtech is also, it's a business which caters to the construction industry, and there is usually cyclical slowdown during Q2. Overall, in TP Buildtech, we have seen some correction in our margins again. Our margins have declined, but that is more because of higher costs incurred in relation to the new plant that we have set up in eastern part of India. That is getting stabilized. People have been hired, etc. We have still made about 1 crore of PAT contribution in H1. TP Buildtech has contributed that to Tinna Rubber's P&L. And I think H2 will certainly be better. Another initiative in TP Buildtech is in addition of new products. So TP Buildtech right now is just in the space of concrete admixtures. We are now adding other construction system products such as grouting repair, mold release agents, accelerators, etc. So some extra costs have been incurred in development of these products, as well as hiring the right people for the techno-commercial sales of the business. So it's again sort of investing in the future, which has impacted the P&L, but we are very confident and very, very optimistic about that business.
Okay. Thank you so much. That's it from my side. All the best for your next quarters. Thank you.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Mihir Vora from Equirus. Please proceed.
Yeah. Hi, Subodhi. Hi, Gaurav. So my question basically was on the EPR side. This quarter we are seeing a higher accrual of EPR, actually around 15 odd crores. So just wanted to know, what are you expecting as a run rate for EPR going ahead?
So hi Mihir, Subodh here. So in the Q2 we have made the Q1 and Q2 on account of both the quarters accrued EPR we have taken into the books, and we believe Q3 and Q4 also almost identical going forward.
Right. So what are the receivables here in EPR? How much have you received here?
Sorry?
So how much amount have we received out of this amount which we are realizing here in the P&L?
So, see, this is the accrual, from the current quarters only, and we still have, almost 2 years to trade these EPRs. So, we are waiting for the right opportunity to, further make, transaction with the prospects. So, as of now, we are holding, but we hope to sell EPR units maybe in Q3 and Q4 when, the requirement actually comes from the user sides to complete their obligation.
All right. Okay. And secondly, sir, on the now that we are into quarter 3, and how are you seeing the traction now into the different segments like infrastructure and mainly industry and infrastructure segment? Has the traction now picked up? Are we seeing increase in the infrastructure activity?
Yeah, we are witnessing, Q3 should deliver good on the infrastructure. There is a bounce back, and we feel that Q3, Q4, there is a good amount of, on the infrastructure side. This business will further bounce back, and we believe that it will contribute like it has contributed earlier. This segment will remain as a stronger and the larger part of our total top line.
And on the industrial side, are we seeing new customers?
That too is growing. In fact, if you see Q1 and Q2, it has progressed. We have made significant, growth in the micronized rubber powder side, and in fact, with the reclaimed rubber, this product is also now we have expanded almost 4%. If you see, traditionally we were low on the reclaimed rubber sales side, but this year it is also contributing, and we are further growing in this segment in the exports also and in the domestic market also.
Okay. So then lastly, on the Saudi Arabia part, basically in the start of the year, we were expecting this project to, be commissioned by the end of this year or somewhere in the second half, but there are some delays here. So, what is the specific reason? Like, are we finding tough to get a land, or what are the reasons why this project has been delayed?
Hi, Gaurav here. So in South Africa, yes, it has taken us more time than we expected in getting the consents from the government, whether it was for land allotment or permission for starting to build. This will take, I think, at least one more quarter to secure all the permissions, and only after that the work will start. So yes, we are probably 2 quarters behind in terms of starting the work in Saudi Arabia. But I don't see that to bring about any major challenge. I still foresee that we will be able to commence production and have the plant set up to take benefit of it in second half of FY27.
Right. So then from Saudi Arabia, we will be targeting any specific geographies, or it will be first Saudi and then expanding it into the other geographies?
Saudi Arabia is the largest economy within GCC, so it makes sense, to be present there. At the moment, we have some customers in Saudi Arabia that we cater to from Oman. So with the plant in Oman and with the plant in Saudi, we think we are very well placed to service the local rubber industry within GCC, of course, parts of Africa, and any surplus still makes viable, commercial sense to bring to India. That's our strategy.
Okay. That's all from my side. Thank you.
Thank you. The next question is from the line of Harsh Maru from Tinna Capital. Please proceed.
Thank you for this opportunity. So, sir, my first question is relating to the Oman business. So, in terms of the overall revenue piece, what do you expect Oman to contribute in FY27, and any updates you would like to give in terms of the expansion over there?
So Oman, is already operating, as we mentioned in our opening statement, it's operating at about 85% capacity utilization. So Oman, in its steady state, will contribute approximately 30 crores to our top line.
Right, sir. And in terms of the consolidated revenue, So how do you foresee FY27 to look like, given that we are looking at FY26 with about 12 to 15% top line growth? How do you foresee 27 from an industry perspective as well as specific to our company as well?
See, for us, we had always envisaged the sales from the capex which is currently underway to only really show impact in FY27. So that forecast remains intact, combined with some growth from our existing lines of businesses that we have. We still expect FY27 sales to be approximately between 725 to 750 crores. Of course, once we do our budgeting, over the next few months, we can give you slightly better guidance to it. But I believe we will be in that zone.
Sure. And lastly, sir, in terms of the procurement piece, so are there any incremental efforts or strategies that you are deploying from a 2 to 3 year standpoint in terms of procurement specifically?
Absolutely. We are always on the task to make our procurement more efficient, which can help in enhancing our gross margin. We have some very interesting strategies underway. It's a bit premature to discuss it today on the phone, but on this call, but we have that underway, very much so.
Sure. Thank you so much and all the very best, sir.
Thank you.
Thank you. The next question is from the line of Mahid Ahmed from Pinpoint X Capital. Please proceed. Hello, Mr. Ahmed.
Yes, can you hear me? I'm audible?
Yes, you are. Please go ahead.
Yes. Thank you for the opportunity, sir. Sir, my first question is regarding what would be the payback period of recovered carbon black project, sir?
See, we expect the RCB and the pyrolysis plant to be approximately 4 to 5 year kind of payback at this point of time, but it is looking good.
So what is any kind of risk do you see in terms of getting those numbers, or any a problem in terms of commodity prices do you see?
I didn't understand your question. Can you repeat, please?
Yes, sir. Sir, do you see any kind of risk due to the commodity prices of rubber and others impacting any margins and your payback?
No. We have, I think, clarified this in our earlier earning calls as well, that the motivation to use recycled rubber materials is always very high. It's all about how much inclusion can happen, because at any given time, recycled rubber materials will be, 1/3 or 1/4 the price of virgin polymers. So that motivation always remains quite high for use of recycled rubber materials. So to that extent, we are not really linked to the price of virgin polymers.
Okay, sir. And sir, how do you expect your PC and MB business to go going forward? Any guidance of the top line, sir, in the coming years?
See, the PCMB business is a new piece for us as well, and I think we have made it very clear in all our earning calls that we have set up a pilot investment. We got into it because it also has a strong connect with our, getting into the RCB business, because master batches, which is part of our PCMB vertical, also uses a fair amount of carbon black, but as a result also virgin carbon black. So this is helping us develop much better understanding of the behavior of carbon black as well. In terms of growth prospects, we are very confident with the kind of pipeline we have of product approvals and the engagements that our team has done with various customers. We believe this business going forward will contribute even in the next financial year, we think about 5% of our top line, 5 to 6% of our top line.
Okay. So, sir, finally, regarding the working capital, how are we going to, especially as senior receivables have jumped up quite significantly, how are we going to manage working capital and sustain a good operating cash flow as you are targeting a very improved ROC in coming 2 to 3 years? How are we going to structure that, sir?
Firstly, I don't think we have any major jump in our... We have an 8 days increase. So that's not substantial in any way. And like I said, in Q2, generally things tend to slow down a little bit for us, and it recovers in Q3. So I don't see any constraint or challenge on the working capital side.
Okay. All the very best, sir. Thank you so much.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Man from Growth Sphere Ventures. Please proceed.
Hi, sir. Thank you for this opportunity. Sir, I would like to understand more on your recycled black carbon plant that you are planning, right? So, if I'm not wrong, you said 75 TPD, right?
100 TPD.
100 TPD. Sir, what would be the cost of this whole capex that will be carrying out, and what will be the cost of machinery that will be putting for this RCB plant?
I don't think we would like to go into all these kind of details on this phone call. Overall, the entire project of pyrolysis and RCB plant will cost us approximately 50 crores.
So it is approximately 50 crores. Okay, got it. And are we basically importing this machinery or from China, or are we basically importing these machines from Europe? Because I think there is one more player who's doing the same, and hence just wanted some clarity on our part.
So we consider this information sensitive to our business, and we would not like to disclose.
No worries, sir. Sir, on this 50 crores of investment, what would you be basically projecting your asset turns to be?
We believe in FY27 the RCB pyro business to contribute about 100-125 crores to our top line.
So it is 2.5 times approximately. That's the sort of asset turn that we are looking at. Fantastic. And is this margin accretive with from our current business mix, that what we are seeing 18%, or it will be at the similar level at what we are projecting right now?
We expect it to be in line with our current operating margins.
So approximately 20%, something that's what we are currently operating at, right?
To put a number to it, we are currently operating, our Q2 margins were 18.5%, our H1 margins are 17%. So it's within that range.
Got it. That's all from my end. Thank you so much, sir.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1 on your touchtone telephone. The next question is from the line of Yash from Inved Research. Please proceed.
Yeah, thank you for this opportunity, sir. So, sir, as a previous participant asked the question, I would just like to extend that. In last phone call, you mentioned that around 23 crore would be the capex on this pyrolysis plant, and now you just mentioned that around 50 crores is the capex. So, I just wanted a clarification on this.
So the total capex, pyrolysis, RCB, the civil infrastructure, everything all in will be about 50 crores.
Okay. And sir, again, I think I would be repeating this question, but just from an industry point of view, the industry is quite a bit slow and other participants are also not performing. So what gives us this confidence that in H2, for whole year, we are targeting around 15% growth? So in H2, we would have to grow in the north of around 30%. So what gives us this confidence, and how do we look at the industry going forward?
See, for us, industry-wise, our performance, etc., is actually not comparable to our peers and people, companies in our business. We are operating and have traditionally operated now for a few years consecutively at far better margins than our peers. And I think we've mentioned that before. It's because of the unique model we have of being a pan-India business, having diversity of raw materials, diversity of applications, and that is what has given us the ability to work at better margins and ability to get growth when sometimes our peers have not seen it. With the order book and with the business that we are seeing today, the guidance I have given, I will repeat, that we expect to finish the year at around 12 to 15% growth over previous year.
Nice. And sir, on the Warli plant, by year end, what kind of capacity utilization are we expecting and what kind of revenue are we expecting in H2?
I'm unable to give you isolated revenue and those details out of Warli, but the Warli plant is now operating at a steady state of 60-65% capacity of utilization. I think that will remain to be the case.
And sir, on the export side, you mentioned that you wanted to increase the exports up to 30%. Could you please share what products are we trying to export and what could be the margins on them and which will be the market?
See, on exports, what I can share with you is that we are expecting to finish the year with about 30% growth over previous year. We have consistently mentioned in all our earnings calls that we have seen and continue to see headroom, a lot of headroom for growth in our exports business, simply because we are starting from a lower base. And our exports are coming from, the products that we make, crumb rubber, reclaimed rubber, micronized rubber powder, tackifiers. Those are the products that are, that we are focusing on for exports. And once the RCB plant commissions and starts, we will, of course, focus and add RCB to our product mix as well.
Okay, sir. Thank you so much.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Viraj from MoneyGrow. Please proceed.
Hi, Gaurav. Well, seems like FY26 is turning out to be slightly slower than expected, as you mentioned. However, to achieve the 1,000 crore revenue target 28, it would mean you would need to accelerate growth to 30% in 27 and 33% in 28. Are you comfortable with that?
We continue to be comfortable with that. We have various new initiatives underway, whether that is the PCMB business, the RCB business, the Saudi venture, South Africa, etc. So I think with all these opportunities, we remain confident that we will be able to deliver or get to that 1,000 crore target.
Great. Secondly, in markets such as Saudi and Oman, which are smaller markets in terms of revenue growth opportunities, just given the size of the local market, are you getting other benefits such as premium pricing or lower working capital requirements in those markets, which then make sense to be in them?
See, Saudi I cannot comment right now. I mean, our forecast is that, it's an attractive market, but for Oman, definitely Oman has, its unique benefits. It's a very efficient market, well-organized economy, and us now being able to sell 40% of our production within GCC, that's, a very attractive proposition because that customer and clientele we cannot compete effectively. We can't service out of India. Those tires have to be sourced and processed locally. So it opens a new market segment for us. That's attractive.
Are you getting better pricing there vis-a-vis India, price per kilo on a comparable product and better working capital terms in terms of
I think the right way to look at it is the margins at which we operate in Oman versus the margins at which we operate here. Oman, when it started, it operated at far better margins than India. Of course, over last 3 quarters that has come down. And I have already, I think, covered in my opening comments as well as in our presentation that we have secured permission in Oman now to also bring in tires from neighboring GCC countries and other places, which has helped cool down the prices of raw material in Oman, which will bring the margins back.
Understood. So Oman are higher margins and comparable payment terms, better receivable days than India?
It's similar to India.
Okay. All right. Thank you. All the best.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Mr. Pranav Bora. Please proceed.
Hello, sir. Good afternoon.
Good afternoon, Pranav. Please go ahead.
Sir, like almost my questions are answered, sir. So I just have one or two small questions for you. So what profitability is dependent on EPR credit sales?
Pranav, EPR credits cannot be seen as separate in our view anymore. EPR earnings is like any other revenue stream and integral to our business. And it is very hard to isolate and tell you because, EPR, the sale itself, it just drops to the PBT level. So therefore, the only way to look at EPR benefits now is as part of your regular business and integral part of the business.
Okay, sir. And sir, I have read somewhere like we have lost our subsidies are in loss, sir. Like Oman subsidies in loss, sir. So what's the reason behind that, sir?
Oman has been profitable all through. It is only in the Q2 where we have slipped into a small loss, but we expect that to change in Q3. And that is the only subsidiary, I think, which is relevant here for this conversation. I mean, South Africa is a very new operation, not even 6-7 months old, so it will take some more time to stabilize. That's to be expected. TP Buildtech is an investment for us, is profitable. There is no challenge there. And Saudi Arabia is still in startup phase. I mean, we've not even broken ground there. So whatever small loss we have to capture it and allocate it correctly to Saudi Arabia, but that is going in relation to just getting the business started there.
Okay, sir. No worries. And sir, lastly, if can you just provide me the guidance for PAT level and EBITDA level, sir?
See, we are at 17% EBITDA margin for H1 for this financial year. We expect to maintain that, possibly even improve on it because our Q2 margins have come at 18.5%. This will lead to PAT conversion of approximately 10% of our top line.
Okay, sir. Thank you, sir. All the best.
Thank you.
Thank you. The next question is from the line of Shashank Agarwal from Shishko. Please go ahead.
So I had 2 to 3 questions. They are based on the entire industry and they are not company specific. So how is the demand from the high quality producers like the tire makers and other automotive parts manufacturers?
Hi, Subodh here. So like industrial segment wherein we cover, the tire industry and automotive parts and all, this is growing. A reason behind one, all these tire companies are, they have a carbon neutralization mission. So slowly they are encouraging and improving the content of recycled rubber material in their formulation. So that is driving a demand. And secondly, the products we are exporting from, India, that all are majorly covered in the industrial segment. Again, the tire industry and the rubber automolded goods. So that is basically helping us to improve in the, that segment.
So, but the impetus is from the carbon neutrality angle and not the benefit of the product angle, right?
Sorry, I didn't get you.
The driving force behind this is the carbon neutrality angle and not the benefits of the product itself, right?
No, the tire industry is gaining benefit also out of it. I'm sure they have the, cost saving on using the recycled rubber material in their system. So that is there. But at the same time, it is helping them to achieve their sustainability goal as well.
And the last question. So what do you think will be the growth? Will it come from the crumb rubber segment or will it come from the pyrolysis segment? Which part is more favorable for you, Michael?
See, the RCB and pyrolysis is we yet to start and, we yet to see the results. But we see, this business will help us to strengthen better because the market and the, business area is almost same, wherein we have already presence. So we do not see any challenge to, market the product out of RCB and pyrolysis business. So we don't, so that's the thing. But more focus will be the overall tire recycling and the recycled rubber material. So RCB and all, these all are the part of recycled rubber material basket.
And so is that total addressable market and the market maturity more in the pyrolysis segment because the tire oil and this recovered carbon black segments are very old?
No, recovered carbon black segment is not old actually. Till now, what the people
carbon black.
Carbon black is there. Virgin carbon black market it's a huge. If the industry thinks of replacing 2-3% of the virgin carbon black, that itself is a very big, the demand can be generated for the RCB. So, till now, the pyrolysis process base RCB was not actually the correct quality specs of RCB. People were more selling their carbon char. But now with this value addition and the improved technology, this RCB can go back in making of new tires and the rubber products wherein it can replace the virgin carbon black. Partially.
So can it be thought that this pyrolysis project that you are setting up is like a pilot project and based on that result you can set up a much larger facility later?
Hi, Gaurav here. So this cannot be considered as a pilot project for the scale and the size that it is being set up. But yes, for us, if all goes as per plan and everything turns out as we have expected, then for us this would be a fantastic validation to take it to other geographies. This has been our model all through, where we have made something successful in one region and then we have taken it to multiple other regions. So that is what we will do, and our intention would be to then kind of pick up this business which is, let's say, 30,000 tons of tire recycling per annum and then take it to southern India, northern India, outside India. All those opportunities open up because we have the experience and presence in all of these geographies.
Thank you. Thank you for the reply.
Thank you. A reminder to the participants, anyone wishing to ask a question may please press star and 1. The next question is on the line of Chandra Gupta, an individual investor. Please go ahead.
Yeah, thank you for this opportunity, sir. I have quite a few questions, but let's see how we can squeeze in how much. So the first is, we had a product called this thermoplastic elastomers, right? PP, sometime back we had launched, which was supposed to be a premium product. So is it there or what? I don't find any mention of that in the presentation. So, if you can
hi, Gaurav Sekhri here. So the thermoplastic elastomers are part of our polymer composites business only. We just refer to it as the polymer composites business. That's why you're not seeing it being referred as TPE.
Okay. So where is it clubbed out of the 4 segments that we mentioned: infrastructure, industrial, steel and consumer? So where does it come in? Out of the
it is not part of any of those. It is a separate vertical under the what we call the PCMB business, polymer composites and master batch.
Okay, fine. I got it. Secondly, so I want to understand actually why there is this so much of volatility in the EPR revenues. Is it not that the revenues are directly linked to the quantum of tires that we process? Doesn't it happen that way?
Well, you're right. EPR is generated out of what we process, but of course there is some variability on account of the kind of products we process, because it is linked to the end products that are made when we recycle. But, why you are seeing maybe little bit of volatility quarter on quarter is because we will only capture the credit of EPRs once they begin to reflect on the EPR portal. Because until that happens, it is not prudent for us to account for them.
Okay. So this quarter you have captured this 15.5 crores roughly. That is on account of that, is it? But they have done some clubbing, or they have maybe recognized it late or whatever. That is what I thought.
That is right. There was some backlog for us, and now that it is reflecting on EPR portal, we have taken them in our balance sheet.
Okay. And this is, you said, is on accrual basis. So how much have you sold actually, and what are the pricing trends like going on? If you can clarify.
We monetize some EPR credits in Q1, correct?
Yes.
In Q1, we monetize some EPR credits. We have not monetized anything in Q2, and we have accrued them. And the prevailing price of EPR credits is the base price itself, which is ₹2.50 a unit, 2,500 per unit.
Okay, that is the minimum that they have specified.
Government has set a band, a floor price and a ceiling price. Right now, they are trading at the floor price.
Okay, fine. Then thirdly, on Saudi Arabia, I just had a clarification. Sir, in Q1, in the presentation, it was mentioned that the area, that land that we are acquiring is 20,000 square meters, and now it's 13,000 square meters. So, is there a change in that? Or? What is the actual land parcel size?
Actually, it's 13,000, sir. What we have told you now, that is the land parcel that we have finally, government has allotted to us. That is 13,000 square meters.
Okay, fine. Because Q1 which said 20,000. Okay, lastly, finally, one last question. Sir, the expenses, I find, the increase in expenses, other expenses as well as salaries is much faster than what the growth we are seeing in the revenues. So, any plans you have to bring those expenses under control?
No, sir. I think on the expenses side, I think we are, again, I would like to, mention here that we have improved on our EBITDA margins, which is, I think, what is most important. Regarding expenses, some of them are front-ended in nature, to bring results maybe 2 quarters or 3 quarters down the road. But the team, people, a lot of those kind of things has to be put in place before. Therefore, you are seeing a little higher expenses than what is in relation to sales. But like I said, we are building our team both on the RCB business as well as on the PCMB business, and that is why you are seeing slightly higher employee-related expenses. Okay,
but you are saying we have improved on the EBITDA margins, which is correct. But if I exclude the EPR revenues, then the margins are actually in decline. And we were without EPR revenues also, we were clogging much higher margins in the past. If I go back to 4 years back or something. So what has changed actually in that?
The EPR margins cannot be isolated now. Earnings of EPR cannot be isolated from our business. Our customers, vendors, everyone is aware of this benefit. It comes into negotiation sometimes. Even it comes into play in our decisions relating to procurement of raw materials. So it's an integral part of the business. I think one will have to see them now together as one.
Okay, fine. I think that's all from my side. I'll join back with you. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I now hand the conference over to the management for the closing comments.
We sincerely appreciate everyone's participation in this conference call and trust that we have effectively addressed all your queries. If you have if you require any further information or have additional questions, please do feel free to contact our investor relations team at Go India Advisors. Once again, thank you for your engagement, for your interest in our company, for your continued support, and to, of course, Go India team for organizing the call today. Thank you.
Thank you, members of the management team. Ladies and gentlemen, on behalf of Go India Advisors Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.